I'm Matt Bishard with REIT.com here in Boca Raton, Florida for REITWise 2014. Joining me today is Tom Wilkin, real estate partner with PwC. Tom, thanks so much for joining us today. Last year at this event when we spoke, you talked about the angst surrounding the global convergence of accounting standards. Has there been any movement in this area over the past year? And I can judge by your smile, I know where this is going. What's your outlook now?
Well, I think the angst, if anything, has gone up. There's certainly a degree of convergence fatigue that is continuing to build, and you can just sense it at some of the joint meetings as to where it's going. And certainly some of the more recent decisions where the two boards are agreeing not to converge around things like insurance, around some of the financial instruments issues, and more recently and more significantly to real estate around the leasing ED if they don't reach an ultimate conclusion of convergence there, which they didn't a week or two ago. That doesn't bode well for long-term complete convergence and may put a halt to it at some point.
And recently we've read about a number of REITs spinning off portions of their portfolios into separate companies. What are your thoughts on these moves, and what are some of the implications?
Well, it's certainly an interesting dynamic, and I expand that dynamic to not just be the existing REITs spinning off portions of their portfolio that don't really fit with the rest of the portfolio, so that you're getting two targeted, focused companies in that regard, and you see those happening, and that's a more recent dynamic. You saw a bunch of them go the other way 5-6 years ago, where you got diversified hybrid REITs, and now some of those are breaking apart. So some of it's unwinding that. But we're also seeing non-REITs spin off REITable operations, especially in the non-traditional space. Things like the CBS Outdoor, billboard REITs, and those are coming about. And those might be more economically viable in the long run because they are really changing the dynamics around the taxability of the entities as a practical matter. But both types of spin-offs, the property type focus transactions as well as the non-traditional spin-offs, come with a cost, and in terms of infrastructure, having to duplicate all of that stuff, officers, audits, et cetera, all come with a cost. And I think all of these companies are betting that the market is going to reward them well in excess of the cost in the multiples on the stock. So I think that remains to be seen. I think some of them will be more successful than others.
And what is the major issue regarding the Financial Accounting Standards Board that you're keeping your eye on for the rest of this year?
Well, I think it's the same laundry list of stuff that was on the table for the last several years. I think on the positive side, there are some imminent improvements that the real estate practice has been looking for a while, discontinued ops in particular. I think the desire would be to have that out shortly so that people could adopt it in the first quarter rather than wait until the adoption date required by the standard in 2014. I think the real estate people in particular will be going for that. And then as a practical matter, the property REITs are looking heavily at the leasing project, which is nearing completion, maybe. We've been saying that for several years. The revenue's probably not a big impact because it scopes out leases and financial instruments, so it doesn't really have broad applicability in our practice to property REITs or mortgage REITs and that side of the business. Might have some stuff on the margin and will affect real estate sales, but not a major day-to-day impact on our REITs. So those are all out there and still percolating through the system, but I don't think there's anything imminent that's going to be a groundswell change for the real estate world.
Tom, thank you so much for your insights.
Thank you.
For more from REITWise 2014, be sure to visit REIT.com.